When we discuss the effect of bonds on the foreign exchange market, we want to look at whether or not the bonds are having high interest or low interest. So usually when the government is purchasing conducting open market purchases, it means that the central bank or the Fed is purchasing government securities from the public, which thereby increases the money supply. And when this happens, interest rates tend to drop. And because of interest rates dropping, the bonds are going to be sold at low interest. And people don't like low interest bonds because higher interest bonds pay more. So they become less appealing. Now, first let's draw a foreign exchange graph. So I have our exchange rate on the y-axis and dollars, this is me America, for example, on the x-axis. And you have your traditional supply and demand. And so basically, if we decrease demand for bonds because they become less appealing, then we're decreasing the demand for the dollar. Because if no one wants to buy bonds, then no one wants to demand dollars, right? No one wants to convert their foreign currency into dollars and purchase bonds when bonds in foreign countries are more powerful because the bonds in America have a lower interest rate compared to the ones in a different country. So this shifts our demand curve to the left. And we have our original exchange rate here and a new exchange rate here. And so when you shift your demand to the left, what happens to supply? Well, supply actually increases. And it doesn't make sense at first. You're like, wait, you decrease the demand for dollars, but then you increase the supply of dollars? Well, the reason why the supply of dollars increase is because Americans are trying to invest in foreign bonds that pay a higher interest rate than the low interest rates in America. And in order to get those foreign bonds, they need to get dollars. That's how they can convert the currency and lower the exchange rate. So then your supply shifts right, increasing the supply. Also, let me mark this. And actually, we can erase this ER2 exchange rate and move our exchange rate to here. See how the exchange rate lowers, but then the dollars after this shift sort of remain constant, so they kind of cancel out. And this is essentially what happens to the bond market, or this is how the bond market influences the foreign exchange market. And sort of the opposite kind of happens when there's less purchase.